company is a manufacturing company. That is only if they are into production of the product or service. Okay, so in that case, they have to prepare a manufacturing account. And finally, the balance sheet. So balance sheet, it lists out all the assets and liabilities of the company. So which gives a clear idea about the financial position of the company. So in the given accounting period. So let's see one by one. Okay. Now let's start with the main objectives for preparing the final accounts. The first thing is no like the company has to know whether they have earned a profit or loss, no, for the past 1 year or for the past accounting year, and they have to know, no, what is the present financial condition of the business. So that can be made, I mean, that information can be made available even by preparing the trial balance, but trial balance doesn't provide a clear idea of what are all the losses which has been made by the company, or what are all the profits made by the company. So only after preparing the final accounts, the company will be having, the organization will be having a very clear idea about, so whether it's a profit or it's a loss, and what are all the current assets and liabilities they hold in hand, and what assets can be immediately cashable, so that in case if there are unpaid debts which are pending for a long period, so that can be immediately cleared off by selling off the what do you say, the assets in hand, fixed assets in hand, I mean, the current assets in hand. Fixed assets, it refers to the, land, building, the patent right, the goodwill of the company, and the machinery, and, so these things comprises the fixed assets. The other things like stock in hand and, accounts receivable. So those are, no, it comes under the current assets. So current assets, no, that can be immediately, made cashable, so that all the unpaid debts, small debts can be cleared off as soon as possible, so that no loss can be incurred in the next accounting period. The company can start afresh. So for these reasons, the final accounts are prepared. So the main three account statement which has to be prepared by any organization is trading, profit and loss account, and balance sheet. So trading account and profit and loss account, so they together are known as the income statements. They are usually mentioned as income statements. And this is one of the final summary of the total accounts, the final summary. So if the company wants to know only the profit and loss of the company, only wants to know whether the company is running profit or whether the company is running loss, so only these accounts can be prepared again at any stage of the business, any stage in the business. So you don't have to know wait till the end of the accounting period. But for preparing the balance sheet, you have to wait till the end of the accounting period. So let's start with trading account. Okay. So it shows the overall results of purchasing and selling of goods. So trade, it means completely refers to the goods. That is the transaction of goods, transaction of the interchange of goods between no two parties, or between the company and an individual, or company and another company, or company with the agent. So whatever is being done related to the transportation or interchange of goods, so that those things, those transactions, it comes under trading account, and it includes all the direct expenses incurred in the business. So whatever is related to the trade, it's considered as direct expenses only. And it provides gross profit earned by the business, and the total sales is greater than the total purchases. That is, if the sales is greater than the purchases made, it is
हाँ,
considered as gross profit. And if the
अरे अरे
total sales is less than the total purchases, it is no mentioned as, it has been no taken as gross loss by the company. Someone has not unmuted. Let me check. Okay. Sarfraz. Sarfraz, please mute your audio. Fine. So this is the format of trading account. So if you see carefully, in the debtor side, the opening stock of the business, the purchases made, and list the purchase returns. That is, if there is any purchase returns, you have to list those minus those purchase returns from the total purchases made, and the remaining the amount or remaining the cost has to be entered in the amount column, and the wages, the customs and import duty, the carriage expenses. So carriage expenses are something that is no like it's like
Ma'am, can you tell me?
carriage in
That's
or
some of the
carriage
informs.
out. So when you're like doing procurement, when the procurement is done from the vendor,
Hi,
whether
ma'am.
it's a raw material or semi-finished components, and those materials has to be transported to the production house or to the business unit. So the transportation part, the transportation cost, the business is taking care of the transportation cost. So there comes the carriage expenses. If the vendor is taking the responsibility of the carriage cost, it is a transportation cost that we don't have to mention it here. But if the company is taking the responsibility of the transportation cost of the raw materials, which is from the vendors to the production site or to the company site, then it has to be mentioned under carriage expenses. And the royalty. Royalty is the royalty amount which is being paid to the owner of the business, because no the business entity is different, the owner is different. So from accounts point of view, so whatever we are getting from the investor of the company, whether it's a cash or royalty or whatever we are know that the business is availing from the owner of the business or the investor of the business, it's considered as a separate transaction. So to royalty, that is those charges are being mentioned here. The manufacturing expenses, all the manufacturing expenses, and packing expenses. Packing expenses relates to all the packaging charges, packing and packaging charges while transporting the goods. That is from the vendor, the goods, few goods cannot be, it cannot be transported, no, in its raw form. So it has to be packed as a bundle, or it has to be no packed in a container, or it has to be packed in a carton. So you need some packaging materials to pack those materials. So those packing and packaging cost, all the expenses that is mentioned in the this column. So you're calculating the total, and the gross profit is transferred to the profit and loss account. So this amount, the final amount, the total amount, which is being no taken as a gross profit, so that will be completely transferred while preparing the profit and loss account. Then, if you take the credit column, so here, whatever sales is happening, because it's no by sales, income is no coming into the business. So, sales less sales returns. That is when sales, when you're returning the product. So when the customer is returning the product due to due to various reasons, no, you're minusing those returns and you're entering the amount here, and you're mentioning the closing stock here, because closing stock, no, it's a valuable asset to the company. So it generates incomes. It's a stock generate income. So this can be no taken into the profit and loss account. So only these three particulars are entered in the credit column. That is sales less sales returns and closing stock. So you're adding up the total, and finally the final gross no is transferred to the profit and loss account. So this is the general format of the trading account. So here I have given the detailed portion of or the details about what has to be mentioned in the debit side of the trading account. That is the opening stock, which refers to the total cost of goods left unsold, and the purchases, all the purchases made by cash transaction or credits transaction, whatever it is. So all the purchases, the wages. wages or salaries, which is like paid to the workers, employees, and everything. And customs and import duty in case of like the business is into export import uh, transaction or export import business. So customs and import duty. So that's considered as an expense. So that is being mentioned in the debit side. The next one is carriage expenses. That is, like the transportation charges you're paying to the transportation agency for bringing for transporting the resources or the raw materials from the vendor, that is from the supplier to the production unit or to the factory premises. So you're taking, that is the company is taking care of the transportation charges. So that comes under carriage expenses. In few organizations, in like it is mentioned as freight in few it is mentioned as just as carriage in or cartage. So all three refers to the same carriage. And then royalty, that is the amount paid to the owner for using his rights. So all these factors, it comes on the debit side of the trading account. And along with these manufacturing expenses, all the expenses in relate which is related to manufacturing. That is like the electricity, the gas, the machinery, and like whatever like used for the production purpose or for the manufacturing purpose, water and fuel, everything used to run the factory. So those come under manufacturing expenses. And the packing expenses, that is amount spent in packing the purchased goods to bring them to the factory. Then from the credit side, on the credit side, what we have to mention is the closing stock. On the debit side, it's the opening stock, and on the credit side is the closing stock. So closing stock, it refers to the total cost of the goods which are left unsold. So this is considered as the expense or the no like I'm sorry income generating asset. So stock is always like mentioned as income generating asset, which is no immediately cashable. So it is mentioned in the credit side. And then sales, that is the total cost of goods sold. It can be a cash sales or credit sale. So anything it may be. So that is mentioned on the credit column. And now we are going to see about the profit and loss account. So this account, it shows all the incomes and indirect expenses related to the business, all the incomes. And if you ask what is indirect expenses, so all the expenses which includes the administrative, that is the general administrative expenses, the selling and distribution expenses, so that are required for the operations of the business. The general operational expenses, so that is considered, that is mentioned as indirect expenses in accounting terms. So it provides this profit and loss account, it provides the net profit earned or net loss suffered by the business. Whereas if you see the other one, it shows the gross profit, I mean the gross profit or gross loss, the trading account. Trading account, gross profit and gross loss are finally like taken into account, and it is transferred to the profit and loss account. While preparing the profit and loss account, when you arrive to the final end, so it shows the net profit or the net loss. This is the format of the profit and loss account. So in the debtor side, if you closely watch, the gross loss brought down. That is, whichever is not like carried forward in the trading and trading account as gross profit or gross loss. So that is being like taken here as the first factor in well preparing the profit and loss account. So whatever, like it's a gross loss. If there is a like whatever amount is in the gross loss column in the trading account, so that is taken here in the debtor column. And whatever amount which has not been mentioned as the gross profit column in the trading account, so that is mentioned in the creditor column here. And then salaries. So salaries here represent all the expenses, rent expenses, commission paid the commission paid for loan or whatever it is, credit transaction or whatever it is. So again, it's an expense. So advertisement is an expense. Bad debts. Bad debts is something that is no that credit sales has been done and the receiver of the goods, the buyer of the goods hasn't paid for the goods. That is, he is not going, the organization, the company or the individual who has bought the goods from the company, so they are not going to pay at all. So the company has lost the hope in them. So those, those factors, no, it comes under bad debts. So bad debts comes as no like expenses only. It's a loss actually, expenses. And a discount. So whenever a discount is given by the organization to its customers or it's to its clients, again, no, like there is a it's a kind of a loss. So finally, when you know arrive to the total, it becomes a net profit. Net profit of all the transactions, all the expense transactions. On the right hand side is the creditor column. So in the creditor column, the gross profit, that is, which is being calculated in the trading account. So that is being brought forwarded here and interest received. So here interest received is completely the opposite term of commission given to the clients or commission given to the vendors. So here interest received is the company would have no like given a loan amount or no like a kind of credit sales that could have been no done to its customers or clients. So if the credit sales, if they are no like paying back after a long time, the company would be asking for no like interest on those sales, interest on that particular no like cost or amount. So all those extra money which is coming along with the cost of the original good, so that is now calculated as interest received. And whatever the company has no like deposited in the bank would have no like calculated some interest and they would be no like paying back in no like in the company's account. So that is calculated as interest received. The commissions received and discounts received. So discounts received is considered as a no like uh, advantage to the company. So that is mentioned under credit column. So finally, when you arrive, when you total everything, and it comes as a net loss. So this is how it is calculated, the profit and loss account. So you're adding up the total. So this gives a clear picture. So when if the total of the debtor column is more, so it means it's a loss. If the total of the creditor column is more, so it means no, it's a profit to the company. So that's how no they arrive into a conclusion. Is that clear?
Yes.
Yes,
Yes,
yes.
ma'am, please.
Okay.
Yes, ma'am.
So yeah, I have given a no, like again, I have given no little detailed things about, I mean, detailed explanation about what should come on the debit side of the profit and loss account. So gross loss, which is transferred from the trading account, salaries and wages, and interest to pay and commission pay. So and you have trade expenses. That is everything related to trade whatever no like trade has happened, that is only with the trade, it means it's all the transactions which is related only to the goods being interchanged between the company and the buyers for the company. Okay, so all the expenses, so those are trade expenses, so that is mentioned in the debit side. And printing and stationery again is an expense to the company. And you have advertisements, expense to the company, bad debts, so expense, discount given to the vendor, I mean, given to the customers or clients or to the buyers. So again, it's an expense. So what comes on the credit side is gross profit, which is again transferred from the trading account. The interest received, interest you're receiving from no like bank deposit or from your client, and commission received from your supplier or from your vendor. So these things comes under credit side of the profit and loss account. Okay. So manufacturing account. So why a company has to know, like, create a manufacturing account? So only if it is a production unit, if it has its own production unit, only if it is no like manufacturing its own product. So in that case, manufacturing account has to be uh, done before no like they are no going for preparing the balance sheet. So it's a must. So it's a special account which is prepared only the businesses engaged in manufacturing of goods. So it provides the cost of goods manufactured during the given accounting period. Again, it's not no like usually done on a no like frequent basis. So only no like, given accounting period, the manufacturing account is created. So in case of manufacturer, the account should be prepared prior to the preparation of trading account and profit and loss account. So even prior to the preparation of the account statements, that is the trading account and profit and loss account, the manufacturing account is prepared. So let's see how a manufacturing account is prepared. So this is the okay format. So on the debtor side, the work in progress. So work in progress here mentions the goods which are in process. That is the manufacturing process. That is inside the production house. So whatever, whichever goods is no readily available in the production house, so that is considered as the opening stock. So that has to be mentioned. The total amount has to be calculated, and that will be mentioned here. And the raw materials consumed, whatever raw materials which has already consumed and has become as a no like finished product or semi-finished product. So that is total and rounded off, and it is mentioned in the amount column. The opening stock, that is the raw materials consumed is the opening stock. And what you have to add is purchase of raw materials. So like what is the cost of the raw materials? No, like made, I mean totally purchased. So that will be mentioned here. And you have to list the closing stock of raw materials. That is closing stock of raw material here refers to the raw materials have already gone into the process. It is in the either it is in the process or it has no like completed the process, manufacturing process, and it is no, right now it is no like as a finished product. And to direct wages given to the workers, and to factory overheads, all the overhead expenses to run the factory. That is the production house, not the general organization, not the general administrative expenses, but here it refers to the production units expenses, all the factory overheads. So these things comes under debtor column. And in creditor column, the closing, work in progress closing. So whichever no like products, no like when the production is over, the closing amount that will be mentioned here, and the sale of scrap. Now, usually the companies know like don't discard the scrap. Now, know like for maintaining sustainability and to maintain greener environment. Now they usually go with lean technologies, lean principles like reduction of reduce, reuse, and no recycle. So these are the three main components of like lean manufacturing. So well, whenever the scrap is no like happening, or whenever no wherever the wastage is happening, usually the company sell those scrap or wastages to the to other vendors or to the other clients or agents who need those scraps for recycling or for reuse of those scrap. So that is considered as an income. So that is mentioned here in the credit column. And cost of production of finished goods. Again, it's an income to the company. So finished goods, total cost is calculated and it is mentioned on the creditor column. So this manufacturing account, so as I said, it's only prepared for the prepared in the companies where production is happening, where the manufacturing process is happening. So it will not be like frequently used in in most of the cases. Even when maybe like even in your exam, you may get hardly a question, one question, a small question about know how to go with the preparation of manufacturing account, or you may not get it at all. So it depends, how the question paper is prepared. So anyhow, but you have to know how the manufacturing account is being prepared. So what comes in the debtor column and what comes in the creditor column. And finally, the balance sheet. So it's a financial statement that states the financial position of the business. Now, profit and loss account is different, balance sheet is different. So profit and loss account and trading account, this manufacturing account, so that is prepared to check the while the company has met with any profit or met with any loss. So if the company has met with profit, so it's good for the company. They will go with the same process. So what will be the decision made is they will try to go with more production and more procurement. So they can confidently invest more in the the activities of the company. The shareholders will be much interested. They will not try to invest more, and more procurement production will be happening, and more finished goods will be readily available in their storage unit. Then more advertisements will be happening to push those products to the customers. So everything will be more if profit is high in no if the profit is high for the company. Well, no, after seeing the profit and loss account. Say in case the company has incurred loss. So here profit and loss account, loss is more than the profit. So in those cases, what the management decides, these and all helps in decision making process. Okay. So what the management decides is, so more procurement will not be done anymore. And production will not be done anymore. So the first objective of the company would be try to sell the closing stock, the remaining stock which is left out in the production unit or in the storage unit. They try to push those stock, push the finished product to the market or to the customers as soon as possible, so that expense can be generated, income can be generated. So that is the first, no, I mean, the first thing the management would decide upon. The second thing would be, to clear off, I mean, the clearing of the debts is the other process, but collection of the debts, with the debtors, from the debtors, so that would be the second thing. There is they would have given made a credit sales. They would have given a small loan amount to their who are associated with the company, or many for many reasons a small amounts will not be would have not be collected by the company. So those accounts receivable, no? So first, those things will be collected to generate income to the company. So these account statements, the preparation for these account statements mainly help in decision making, no, for the management. It can be for any management, whether it is top level or middle level or the worker level. So for management decision making, these financial statements, no, it helps very much. When coming to balance sheet, again, it helps in management decision. And not only that, balance sheet is for for all the stakeholders. For profit and loss account, trading account, manufacturing account, of course, it's for publishing, for tax officials, but mostly the tax people, the government, or the stakeholders or the potential investors, they mostly want to rely upon the balance sheet of the company, the final balance sheet of the company. That's what they are very keen to look into, because it gives a clear financial position of the company. So whether the company is doing good or doing bad. So based on the final result of the balance sheet, the potential investor may decide whether to go on investing in the company. The shareholders will be deciding whether to invest more or withdraw from the company, or to make no any hardcore decisions or no like production or no other advertisement or sales and marketing processes. The employees would decide whether to no stick on with the company or move on to another company. So everyone has no like very much no kind of interest in no checking the balance sheet of the organization. So that's why it's no like given utmost importance. The second point is it lists all the assets and liabilities of a business on a particular date. So all the assets and the liabilities are no like listed as no like and credit and debit columns, and the assets liabilities on balance sheet are listed in two orders. It is liquidity order and permanency order. So liquidity order is no like first they will list out all the uh, current assets, no, which can be immediately cashable, so that all these small debts, no, which has been no uncleared for a very long time, it can be cleared as soon as possible. So that the liabilities column would be no very less, very low. The liabilities of the company would become very low, and assets column would be no like very high. The total of the assets would be high and the total of the liabilities would become low. So that is the company will decide upon the first thing to decide upon. That is all the current assets which can be immediately cashable. So those things would be, like considered. So that can be, like sold. That is the stock, remaining stock in the company, or the raw materials, which is of like no use anymore. Say, for example, the demand for that particular product has like has become low in the market. The customers are not demanding the product anymore. So then what is the use of no holding the same kind of raw materials and no work in process materials? So the company tries to cash on it. So they try to sell the raw materials, try to sell the work in process or the semi-finished goods and the finished goods as soon as possible, so that no they can generate no income. And then second thing is permanency order. So permanency order is fixed and current assets, listing the fixed assets and listing the current. So fixed assets are no like which no like it is no permanent till the company exists. That is the goodwill, patent, trademark, the brand, and the land and building, the machinery and the furnitures, and all these things comes, all these factors, it comes under fixed assets. As long as the company is no like alive, so these things will be no like sticking on with the company. So these things cannot be no immediately cashable. No, it's very difficult. If there is no machinery, how the production will happen? If there is no building, where the office will no like work upon? If there is no capital, know how to go with the all the organization's activities. So this thing is at most important. So these things cannot be touched at all. The trademarks, patent rights cannot be touched at all till the company is existing. Whereas current assets, yes, immediately it can be cashable. So in either of these orders, the balance sheet will be prepared. So coming to the format of the balance sheet. So this is the format. So on the left hand side, all the liabilities are listed, and on the right hand side, all the assets are listed. So liabilities. So what are all the factors listed in liabilities? The bank overdraft. So here bank overdraft is the amount payable to the bank. So they might have no like given us a kind of credit to us. On behalf of us, they would have no paid for the like the buyers, or for the sellers of the raw materials, or whoever it is. So on behalf of us, they would have no like made the payment. So for that, the bank would charge no little extra like from the company along with the principal amount. So it has to be the bank overdraft has to be like cleared off with maximum, I think, 1 year. So that is a no liability. And second thing is outstanding expenses. Whatever is now outstanding, all the expenses which is outstanding, so that has to be listed under liabilities. The bills payable. The pending bills, no, which is not paid as of now. So those things come under liabilities. The sundry creditors, that is the creditors, all the creditors who has no lended for the company. So they have to be no paid back. So they come under liabilities. Long-term loans. So loans which has not been no like paid off for a very long term. And uh, loans which which are of very minimum amount, so that can also be like paid off by selling off the current assets. And the capital, so capital also comes under liability. Why? Because capital is the company is obliged to pay back the capital to the investor of the business. So for that matter, capital is being listed under liability. And when on the right hand side, the assets. So cash in hand is an asset, cash at bank is an asset, and prepaid expenses, that's an asset. Bills receivable, which is which is to be receivables from the the buyers of the company. So that those things it comes under bills receivable. And the debtors, so debtors who are no obliged or liable to pay to the company, so they come under assets. Closing stock is an asset. Raw materials, it's an asset. And work in progress or work in process, again it's an asset. Finished goods is an asset. And plant and machinery is an asset. So here, if you see, plant and machinery and plant and machinery, yes, only the plant and machinery is a fixed asset mentioned here. All others you can see is a current asset. So which can be immediately cashable, immediately collectible. But only the plant and machinery, it comes under fixed asset. It cannot be immediately sold off, because it is the main heartbeat of the business, the main vein of the business. It cannot be sold off as easily as the selling of raw materials or selling of the whatever current assets. Okay. So plant and machinery, that would be the last option for the company, uh, to take the decision. So when you total up, no, on the both the sides, total up all the liabilities and total up all the assets. So whatever, the final sum it comes into. So if the liabilities are more, the company, the management would take a decision to limit down the liabilities. And if the assets are more, the company can relax and go on with the next season or next accounting year. So this is the format of balance sheet. Okay. So there is a factor called adjustment in the accounts. So adjustments are something, there may be few transactions which the accountant or the accounts team would have missed out while preparing the journal or ledger or trial balance. So if an entry has been missed out right from the beginning, and I mean not purposely, but maybe because of many reasons, it is not taken into consideration at all while preparing all the account statement. So while preparing the final accounts, the balance sheet, this particular entry, this particular transaction can be made as recorded as adjustment. And not only that, in case of the transaction has been recorded, it's already recorded, it is not left out, but but they do not relate it to the accounting period at all, the present accounting period. Maybe it may be from long back, before 3 years or before 5 years. It doesn't represent the last accounting period. It doesn't come under the last accounting period. So in that case also, it can be mentioned as an adjustment while preparing the balance sheet. So these adjustments are mentioned in the balance sheet, to to it's balancing the accounts, balancing the liabilities and assets. to show the stakeholders and interested parties that the company is not into loss, the company is doing good, or the company is going neutral, neither loss nor profit. So the company is going neutral. So assets are good and liabilities are also there, but assets are also no like there. So to show these things of those missed out transactions or those transactions which has already been entered but which do not related to the last accounting period. So those entries can be mentioned in the balance sheet as like adjustments, and things can be adjusted. So I have given the list of like important like adjustment names, that is the factors which can be mentioned in the balance sheet. So closing stock, outstanding expenses, prepaid expenses, accrued income, income received in advance, depreciation. Depreciation is like it relates to the plant and machinery, interest on capital, interest on drawings, bad debts to be written off, provision for bad debts, provision for discount on debtors, goods withdrawn for domestic use, goods used in business. Usually, goods withdrawn for domestic use. That is, no, while goods are being withdrawn by the owner of the business, cash withdrawn by the owner, or goods withdrawn by the owner for personal use, for his own personal use. No, like usually many companies, like many accounts people, they don't usually mention in there, like while preparing journal ledger. So that will not be, like considered as a most important factor, but it has to be done. But in case if they have missed out in the earlier stage, so that can be, made as a adjustment factor in the balance sheet. Then goods used in business, that is no like giving out free samples, charity or gifts and everything, and goods sent on sale or approval basis. That is for approval of the goods or approval of the particular product. Few goods can be like sent as sample. So that can also be mentioned under mentioned in the account statements, any of the account statements. So these are the adjustment transactions, which are usually left out. Not usually, sometimes left out, but it can be, made as an adjustment transaction in while preparing the balance sheet. Clear?
Yes, ma'am.
Oh,
What
fine.
happened, ma'am?
Yeah. Okay. So we have come to the end of the accounts session. Maybe what I can do is we have only for each and every I mean for these accounts, that is for the trading profit and loss account or the manufacturing and balance sheet. So I can know give like few examples, like I can know provide you few illustrations so that I can do. What I'll do is I will add those examples or illustrations so that you will have a very clear idea, like how to prepare the final account statements. So I will add that, then I will share the PPT with you. Is that fine?
Yes, ma'am.
That will be fine. Okay. So if there is any doubt, you can stay, or otherwise, no, you can leave. And maybe from next week, like we can have a new topic, the new subject.
Okay, ma'am.
Okay, so no doubts. Fine. So yeah, we can meet in the next session. Have a great